IREN reported a $247.8 million net loss last quarter, and the stock surged 7% anyway. That mismatch is the question worth examining. The consensus read is straightforward. NVIDIA signed a $3.4 billion cloud contract, retail piled in, and the stock moved. But NVIDIA didn't just buy compute from IREN. NVIDIA took a 5-year option to acquire 30 million IREN shares at $70 each, a price that sat 15% above the stock's level at announcement. That structure is not a vendor relationship. When a $5.14 trillion company embeds a $2.1 billion upside instrument into a supply deal, it is signaling that the counterparty's equity, not just its power capacity, is expected to appreciate. Capital reading that signal began repositioning IREN out of the crypto miner peer group and into the AI infrastructure peer group before the earnings call ended. The shift in peer group is what drove the flows, not the headline contract size alone. Hut 8, which holds a $7 billion Google backstopped lease with FluidStack, fell 2% the same session, not because its fundamentals deteriorated, but because the market was reallocating AI infrastructure exposure toward the name that now carries NVIDIA's equity conviction. That rotation is a valuation reclassification event, and reclassification events reprice the multiple before the underlying earnings catch up. The $70 strike is the checkoff anchor in this story. It functions as a forward benchmark. If IREN's operational milestones, specifically 600,000 GPU deployments at its campuses, are not achieved, NVIDIA's option never vests and the $2.1 billion instrument expires worthless to both sides. The stock's current price of 61 sits below that strike, meaning the market has not yet priced full option exercise as a base case. What it has priced is the possibility, and that possibility alone collapsed the discount rate applied to IREN's forward earnings profile. But the $70 strike also surfaces something the bullish narrative glosses over. NVIDIA's option vests against GPU deployment milestones, not revenue milestones. IREN can contract $3.1 billion in ARR and still leave NVIDIA's option unexercised if the physical build-out slips. The thing validating IREN's equity is the same thing that could invalidate it, and the company's ability to close that gap depends on an acquisition that most commentary treated as a footnote.
The $625 million Mirantis acquisition reframes what IREN is actually selling, which is why it changes how the $3.4 billion NVIDIA contract should be read. Before Mirantis, IREN's competitive moat was power, secured megawatts that hyperscalers could not easily replicate. That moat is real but fungible. CoreWeave and Nebius hold similar power assets, and a power landlord trades at a power landlord's multiple. Mirantis adds 650 engineers carrying the K-Cordings Kubernetes platform and an enterprise customer base, meaning IREN can now manage the full AI workload stack sitting above the GPU layer, not just supply the GPU layer itself. That is the distinction between a co-location provider and a cloud operator, and those two categories carry structurally different valuation multiples in institutional models. The counter-signal worth examining, Mirantis was acquired for stock, not cash, at a moment when IREN stock had risen 813% over the prior year. Paying $625 million in appreciated equity for a software layer is capital efficient, but it also means IREN's share count expanded precisely when valuation pressure is highest. The dilution is not disqualifying. 95% of the Microsoft GPU capex is funded through prepayments and sub-6% GPU financing, so cash burn is structurally contained. But the Mirantis deal changes what IREN needs to prove next. It is no longer enough to show contracted megawatts. The Microsoft contract makes this concrete. The $1.94 billion average annual revenue figure attached to the Childress deployment is not a power sale. It is a managed compute commitment, the kind of contract that requires operational software infrastructure to service. Without Mirantis, IREN would have been delivering power to Microsoft's own engineers to manage. With Mirantis, IREN retains the operational layer, and critically the margin on that layer. That margin differential is what separates a 300-megawatt co-location deal from a $1.94 billion managed cloud contract, and it is what justifies comparing IREN to CoreWeave rather than to a real estate investment trust. The problem is that the Mirantis integration is not yet reflected in revenue. As of Q3, Bitcoin mining still accounts for roughly 91% of IREN's reported revenue. The $33.6 million in AI cloud services represents the operational footprint of the new business model, but $33.6 million against a $20.84 billion market cap implies a forward multiple that can only be justified if the ramp materializes on schedule, and the schedule depends entirely on the Childress handoff to Microsoft in Q3 and the broader 480 megawatt capacity delivery target for 2026. The gap between what IREN earns today and what it has contracted to earn is the single variable that determines whether the 70 strike becomes a floor or a ceiling. 91% of IREN's current revenue still comes from Bitcoin mining, the business the market is explicitly devaluing. Mining revenue fell to $111.2 million from $167.4 million sequentially, and CFO Anthony Lewis confirmed additional non-cash impairments are coming as legacy hardware is decommissioned. That sequential decline is not a risk in isolation. It is the scheduled cost of transition. The question is whether the AI cloud ramp absorbs the mining revenue drawdown before the forward PE of 63x begins to compress under its own weight. The $3.7 billion ARR target for year-end 2026 is the stress test. IREN has $3.1 billion already contracted, which sounds like the heavy lifting is done, but the contracted figure and the run rate figure are not the same thing. Contracted ARR means agreements are signed. Run rate ARR means capacity is live and billing. The 480 megawatt of AI cloud capacity targeted for 2026 delivery, anchored by the 300 megawatt Childress handoff to Microsoft, must go operational for contracted revenue to convert to recognized revenue. At 63x forward PE, any slippage in that conversion timeline does not produce a minor earnings miss. It produces a valuation framework collapse, because the multiple is priced on the terminal state, not the transition state. The upside path, as a counter-thread, is structurally cleaner than it looks from current financials. The $3.4 billion ARR target by year-end sits on only 140,000 GPU expansion, 16% of IREN's 3 gigawatt grid-connected portfolio. British Columbia adds an estimated $1.5 billion ARR on top of that. The 5 gigawatt secured power footprint, including the new 490 megawatt Spanish platform from Nostrum, means the capital intensity of future revenue expansion is already largely sunk. If Childress delivers on schedule and the Mirantis stack proves the managed compute margin thesis, the stock's comparison set shifts permanently to CoreWeave's revenue multiples, not crypto miner EBITDA multiples. The $70 NVIDIA strike price, introduced at the beginning of this analysis as a conviction signal, now functions as a verification benchmark. If IREN achieves the 600,000 GPU deployment threshold that vests NVIDIA's option, it will have proven the build-out velocity required to justify 63x forward earnings. If it does not, the option expires and the stock re-rates toward its current cash flows, which at $59.5 million adjusted EBITDA against a $20 billion market cap, price almost no value in the legacy business. The Horizon 1 handoff to Microsoft in Q3 2026 is the first observable checkpoint, and it arrives before the year-end ARR target demands to be reconciled. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.